Hello and welcome to MSI's latest webinar. My name's Simon Mason and I'm the Sales and Marketing Manager at MSI. Today's webinar is of course a tanker market webinar. So I'm joined by two of our tanker analysts, Tim Smith and Kishan Mithu. Today's presentation will last for 25 minutes and there'll be a time for questions at the end. You can submit your questions using the Q&A icon just to the top right hand side of the screen, just where you see the question mark symbol. If you don't get round to asking us a question before the end of the presentation, don't worry, you can also email it to us at info@msiltd.com. And now over to Tim.
Thank you very much, Simon, and welcome everyone to this MSI oil tanker webinar. My name is Tim Smith and I'll be covering most of the market outlook through the webinar, but I'll be joined a bit later on in the presentation by my colleague Kishan Mithu, who's an analyst here at MSI covering the oil tanker sector, and Simon will be back at the end of the presentation for the Q&A session as well. So looking at the agenda, we're going to start with a market overview, so a quick roundup of where the tanker sector is at present. Obviously, it's been a volatile year, so we'll take a look at earnings, both in terms of the spot market and the time charter market, before we move on to quite an in-depth look at the demand side. There's a lot going on, of course, in terms of oil markets, in terms of course, COVID-19, the ongoing effects of the pandemic, and also looking at the link between those and the tanker market, which is the trade side too. We've characterized that section as cautious optimism because we are potentially moving into more of a recovery phase in terms of the fundamentals in the oil sector, but there remain quite a few risks around that. The third section is where Kishan will take over and look at the supply side, fleet dynamics of the tanker sector. There's going to be, we expect some significant developments in terms of the fleet, and we'll be looking at what we've called major moves in that component of the market before we finish with a look at our outlook for tanker earnings. So without further ado, let's dive into the market and start with our market overview. The first thing I wanted to show actually was a slide from a year ago. In April 2020, we did a tanker market outlook webinar, and the slide on your screen is exactly what we showed in that webinar for our earnings outlook. At that point, the market was at extreme highs. These are one-year time charter rates for an LR1, a Suezmax and a VLCC. And we were making the prediction that the second half of 2020 would see a rapid and severe decline in those earnings. That wasn't, at that point, necessarily the consensus view in a market which was going ballistic. So it was quite an extreme call based around our expectations for a major shift in fundamentals driven by the huge disruption and collapse in oil demand we saw last year. Fast forward a year and this chart shows you what happened. We've moved from the time charter rate to the spot market here. We're showing spot earnings for 5 benchmark tanker types, VLCC through to MR product tanker, and you can see we did see that collapse. In fact, the timing of that collapse, the scale of that collapse was almost identical to our predictions made in Q2 2020. So we don't always get it right, that's for sure, but in this case, in terms of our expectations for tanker markets, they've come true over the last year, and we've seen conditions deteriorate rapidly And over the second half of 2020, through Q4 and into Q1 2021, earnings levels have stayed very low. We have seen some improvement recently in markets in March into April, but overall conditions remain very weak. So just looking at the spot market, it's worth noting that we've introduced spot market data into the Horizon system for the tanker sector. So you can go into the data section of Horizon and look up both annual and, as we're seeing here, quarterly average spot earnings for our main tanker benchmark sizes. So this is another addition to the system. Again, very easy to access, download in Excel as well. And these are also aligned with our spot market data and forecasts in the Horizon monthly report as well. So just worth noting another new feature of Horizon, and we'll take a look at some of the other features of the system that may be of interest through the course of the webinar. So let's now take a look at the demand side and specifically at some of those elements that are potentially going to help support recovery in the market, obviously in the wider context of the COVID-19 pandemic. So let's have a look at the broader picture for the oil sector. So we've got a couple of charts on this slide. On the left-hand side, we're showing quarterly oil supply and demand along with the Brent crude oil price. And this is derived from the IEA report, the very latest IEA report that came out in April. And so you can get a sense from this of how these two sides of the oil market have behaved since COVID-19 really took hold last year. So we can see, first of all, that collapse in demand really focused in Q2 2020 before a recovery. We've seen that recovery then in Q3 20 not move a great deal beyond the position it attained in the second half of 2020. Obviously, we've had further waves of COVID-19 and associated restrictions with that. So demand's really going in or sitting at a level in the first half of 2021 at around 95 million barrels per day, perhaps a bit below currently. Then if we take a look at the supply, so this is production of oil, the yellow line, we can see the effect of the OPEC plus cuts in Q2, as well as production cuts from other regions. That really brought the market back into balance. And actually you can see in the second half of 2020, demand, despite being constrained by COVID, actually exceeded supply. And that was partially the case in the first quarter of 2021 as well. So that supported the crude price. And you can see that dotted line showing the Brent crude price has really appreciated, moved up towards $70 per barrel recently. It's kind of gravitated back towards about $60 per barrel, but a definite improvement, 100% improvement from the quarterly average you can see back in Q2 20. So all markets have tightened because of that supply side restraint from OPEC. And on the right-hand side, you can see a more granular, longer-term oil price, same price, Brent crude, yellow bar shown on the right-hand axis, but we've put that alongside the VLCC spot earnings on Middle East to Asia. That time series is a combination of what was TD3, Middle East to Japan, and TD3C, now Middle East to China. And you can see a real inverse relationship between the oil price and those VLCC spot earnings. Really interesting. We can see the collapse in oil prices last year coincided with that spike. Obviously, floating storage, excess oil surging into the market, inventory builds playing a part in all of that, and we'll come on to some of that later. But then since oil prices have recovered, reflecting that restraint in supply, reflecting the drop in cargo, the VLCC market is created, and you can see those earnings on that route, time charter equivalent, dropping below zero, moving into negative territory in the first quarter of 2021. When we take a look at one of the areas most hard hit by the pandemic, aviation, we can see in this chart definite signs of recovery. This is showing you the number of commercial flights each month through 2019 as a kind of reference year for normality. Then we go into 2020. Initially, things are looking pretty stable, but then of course COVID-19 hits globally. Those yellow bars plummet into Q2. We do see recovery in second half of 2020 from those lows, but levels remained much lower than 2019. We're looking at maybe around 60% or so in terms of that activity. Then coming into 2021, things are picking up actually. The green bars showing you in 2021 actually a significant increase in March, where aviation activity has moved certainly above the second half 2020 levels, and probably, judging by the data that we're seeing in the first half of April, continued increase. Still significantly below 2019 levels, but notable increase. And when we look at that now on a yearly basis for April, it's a massive change because of that very low base comparison. Some positives on the demand side. If we flip to production, you can see here we showing monthly oil production in three groups. We've got the US and Russia, and then we've got OPEC as well. And we can see the disruption last year. Similarly to the demand, we've seen that modest recovery, then a kind of plateauing in terms of the production levels of these three groups over the last 4-5 months or so. So really going into Q1 21, we've not seen any major increase in output overall. And in total, they're about 5 million barrels per day lower than pre-COVID levels, reflecting the similar drop that we saw in total demand earlier in the slideshow. Now, with OPEC Plus meeting on a monthly basis, there's more room for flexibility from their perspective in terms of production, and they have agreed in April to expand their output across the Q2, so we're likely to see, or will see, roughly 2 million barrels a day of additional production from that group after a very cautious position that they took in Q1. So that's positive for potential trade growth going into the middle of this year. So we can see those changes in production reflected in crude flows. These are estimated seaborne flows from the Middle East, FSU and North America on the three charts shown here, a million tons. And there's a definite, obviously, reduction in 2020 towards the middle of last year. And we've seen those stabilize, in some cases pick up. In North America, the pattern's slightly different outside of the OPEC Plus group, but we've seen a little bit more of a negative slant to exports recently as US refining activity has picked up. So how do we expect crude trade to evolve? So this chart takes us from looking at the historical to the forecast, and we're looking at incremental crude imports. And so we flip from the kind of export side to the import side. So we've broken down this chart by China, other Asia, some minor other sections, and then Europe and the Americas. So these are the principal crude buying regions. We can see the big shock in 2020, This is incremental change, so year-on-year change in million tons in crude imports. Most regions took a major hit last year, particularly Europe, other Asia and Americas. You can actually see China still positive, so reflecting that increase in buying that we saw in the previous slide. 2021, we're not expecting to see fireworks. So we know that Q1 is starting from a difficult comparison. We've already seen that volumes in terms of production and exports are lower year on year. We are expecting Chinese crude import growth to remain positive this year, but it's expected to slow down. And we've got high stocks elsewhere, so we've got an element of pressure from destocking coming into play as well. So there's limited growth in other Asia. We've got very low growth in the Americas, and already we've seen US crude imports down 10% in Q1 2021. Some contribution from Europe, but this is all dependent or largely dependent on improved underlying consumption. It's not until 2022 that we start to see some of the effects of a more balanced oil market, lower inventory levels, continued strong demand growth supporting rising refinery throughput, and then we see some more contributions from a broader set of regions and larger incremental gains in terms of crude imports. So it's a kind of 2-year recovery, if you like, in terms of the trade volumes. Beyond that, we start to see the effects of slower oil demand growth, more secular trends there. And also we're seeing some impact from things like refinery closures, which unfortunately we don't have a huge amount of time to go into in this presentation, but are an important element of the demand landscape. And you can see, looking longer term, we expect positive contributions from, say, Europe to actually turn negative, and it's really Asia driving longer term crude trade growth. So turning our attention from the crude sector to products, this slide just has a couple of charts. Firstly, looking at refined product intake across 3 regions. We've got Southeast Asia, Europe and the US. The US is shown on the right-hand axis. And we can see for both Europe and the US notable impacts from COVID-19, from 2020's demand drop. But we've also seen over the second half of the year, and particularly actually recently for the US, significant recoveries in terms of product intake. So this perhaps bodes well for the market in 2021. And when we look at Southeast Asia, actually, although that's been fluctuating, it's been trending upwards, and certainly Q1 21 is significantly higher than periods in, say, Q3 2020. So some positive signs there. Obviously, a lot of this to do with stockpiling or increased inventory builds in Asia. We're seeing Chinese exports rising. That's contributing to intake into places like Singapore, for example. But when we look at our expectations for growth in products trade on the right-hand side, again shown incrementally, so year-on-year change, we can see a bit more of a positive expectation in terms of 2021. So there isn't obviously the impact of reduced collective production and exports as there is in, say, OPEC or from OPEC. So we've got quite positive growth in the Americas, in Asia as well, and some contribution from Europe. After what was a very large drop in 2020, and that continues through 2022, more expanding imports from Europe. And again, this also is supported by reduced refinery capacity. So the US and Europe so far have been 2 of the centres for refinery shutdowns. Further out, again, we see some of that incremental growth muted as a result of weaker underlying oil demand growth, but we also see refinery shifts having an impact too. So, for example, in Africa, we have the Dangote refinery coming on stream towards the middle part of this forecast, and that has a negative effect on refined product imports into Africa. So again, just taking a look at some of the additions we've made to the Horizon system on the product side, we've added clean and dirty bilateral trade. So we've always had a large volume of oil products trade. This is total refined products. We're now splitting these out into clean products, so majority gasoline, diesel, naphtha, jet fuel. And as you can see here, this is the interface where you can look through the multiple routes we have. And this is also split into dirty products, primarily fuel oil as well. So these are estimated volumes, but they're breaking down and providing more detail on the product demand side for our users to download, use, analyze, and so on. Aside from the trade flow dynamics, though, for both crude and products, what's been really critical to understand about the tanker market demand side have been some of the disruptive impacts from port delays, in particular in 2020, which have distorted the demand side and actually supported the market, absorbing tonnage last year. And you can see from this chart, particularly in Asia, even as trade volumes have dropped substantially. So that's kind of offset and provided some uplift to demand where there would have been much more severe ramifications. And also we have an estimate of speed and index of speed as well, and we've seen slowdown in terms of tanker speeds as well, providing some counteractive influence on demand, supporting it in the face of sharply declining trade volumes. The flip side to that is that as these factors normalize going forward across the forecast, that will have the reverse effect. And even as trade volumes improve, as some of these abnormal conditions ease, they will in effect release more tonnage into the market, or the availability of tonnage, and improve the availability of tonnage, which will suppress some of the demand recovery. So if we look at the demand or metrics of demand in the round, in this chart we're showing percentage change in oil consumption, in combined oil trade for crude and products, and for deadweight demand for tankers across crude products and chemicals. So this is anything above 10,000 deadweight. We can see those effects happening. So looking historically, you can see the green bar's deadweight demand typically higher than the trade volumes. That's reflecting the positive impact of increasing long-haul trade, for example, from the US to Asia. Then we hit 2020, massive drops in both underlying oil consumption and oil trade, as we've seen. But that deadweight volume is more or less flat, supported by some of those extraneous factors, port delays, in particular we saw last year. So as we go into 2021, this year we're expecting quite strong growth in oil demand. Caveat that obviously with the risks we're seeing weighted into the second half of the year, but the seaborne trade volume, partly restricted by crude output from OPEC plus, is a bit lower, and then the deadweight demand growth is lower still as some of those factors unwind, and tanker availability is effectively increased this year. 2022, as with trade, is when we see a firmer, stronger acceleration in deadweight demand growth. And then beyond that, we start to see conditions flattening out a bit in terms of the deadweight demand as a result of significantly lower underlying oil demand growth. And you can see those dark blue bars really dropping down. So oil demand growth kind of normalizes or reduces to below 1%. And we start to see some of the impacts we've seen from shifting refinery capacity, for example, taking an effect on seaborne trade and deadweight demand as well. So there's going to be a mix of factors. It's a complex combination of drivers on the demand side. It's taking more and more to keep track and keep on top of these factors and synthesize them into a clear picture. But that's what we're trying to do at MSI in terms of quantifying a lot of these factors to provide that underlying structure to the market that helps us understand the fundamentals and how those play into the outlook for earnings. So with that, look at the demand side. A lot of factors involved. You can find a lot more in our quarterly reports and indeed in our monthly reports and on the Horizon system in terms of the data. But that was a quick overview. Let's move over to the supply side, the fleet, and I'll hand over to my colleague Kishan, who's going to run through some of the key dynamics we see affecting that over our forecast. So over to you, Kishan.
Thank you, Tim. So I'll be taking us through the supply side. If we start off by looking at overall fleet dynamics, the chart on the right shows deliveries, deletions, and the end of period fleet growth, which is the fleet growth at the end of a given year in this case. In 2020, you can see that fleet growth was fairly high, despite lower deliveries, and this was due to much weaker scrapping. Across the first half of the year, tanker earnings were really high, and this discouraged owners from removing vessels from the fleet. In 2021, we expect fleet to contract, and this is because of the build-up of older tonnage over recent years, and our scrapping forecasts are also supported by the current earnings environment, which remains low. Moving forwards, we expect high scrapping volumes to be a dominant feature of our forecast, while deliveries will be limited by lower contracts. As such, we expect the fleet to contract over the next 5 years. So we recognise our scrapping forecasts are very strong, and to help highlight the need for such large removals, here we show how the 20-plus-year-old fleet would develop if there were no scrapping over the next 5 years. So you can see in 2021, under the no scrapping scenario, the 20-plus-year-old fleet almost doubles, and this continues to grow to over 25% of the total fleet by 2025. And it's just worth highlighting, even under our base case with such high scrapping volumes, that the 20-plus-year-old fleet shows no material reduction over the forecast, with a slight uptick in 2025. Across 2020, there are a number of supply-side disruptions, the main one being the rise of floating storage. So as oil demand crashed in 2020 due to COVID-19, the demand for commercial floating storage rose as onshore storage facilities reached capacity. Commercial floating storage levels fell across the final months of the year as oil demand began to recover and production cuts limited supply. As of March, we estimate commercial floating storage levels to be comparable with the start of 2020. As well as the rise in commercial floating storage, the tanker supply was also affected by ongoing US sanctions against Iran and Venezuela, and effectively this removed both state-owned fleets from the trading fleet. And the effect of all of this was to keep employment rates elevated. So to understand how the tanker fleet has been affected by what we've discussed, here we show the actual capacity fleet growth and the available fleet growth. The actual capacity is all existing tonnage, and the available fleet is all existing tonnage, less those in commercial floating storage, scrubber retrofits, or repair and maintenance. In 2019 and 2020, you can see that the actual capacity fleet growth is high due to weak scrapping, while the available fleet contracted due to scrubber retrofits and commercial floating storage. In 2021, the return of these vessels from floating storage sees the available fleet grow by over 5%, while the actual capacity grows by a more mute 1%. Further out, we expect these two fleet metrics to begin to converge as the unavailable fleet normalizes, with both fleets contracting post-2023. I shall now be handing back to Tim, who will continue with the presentation. Thank you.
That's great, Kishan. Thanks very much. So let's take then what we've looked at on both the demand and supply sides, bring them together and see how the underlying fundamentals are going to shape up for the tanker sector across our forecast. So here we have the combined supply and demand growth for the tanker sector. We're looking at 10,000 deadweight plus. And we've also got the utilisation rate or employment rate for the market as well. So that's showing you the kind of balance of those fundamentals. With the supply growth, we've kind of reversed that. So where we have positive growth, it's shown as negative, just to illustrate the overall impact, net impact on the utilisation rate. As we saw at the start of the presentation, tanker markets remain highly correlated across both crude and product sectors. So it's beneficial to look at the market as a whole to understand wider utilisation. And we can see that strong growth in the available fleet this year having a negative effect on market fundamentals. Limited changes in 2020, despite the huge upheaval in market conditions, because we've seen those counteractive factors on both the demand and supply sides. More positive conditions expected in 2022. That's when we really see demand outpacing supply growth. Beyond that, those demolitions volumes that we've seen in the supply section really start to come into play, and you can see that light blue bar actually turning positive. So reduced or contracting fleet capacity is having a positive effect on the market, even amidst relatively subdued demand growth, and that's driving that utilisation rate higher across our forecasts. So post 2021, a pretty positive outlook for the sector, but it remains dependent on that scrapping materialising, and obviously it remains dependent on a relatively speedy recovery in terms of oil demand from COVID-19. So just before we move on to the outlook for earnings, I just wanted to show another way we've developed to keep track of portfolio analysis, both for earnings and asset prices, with an Excel add-in. So you can use this to input vessel IMO numbers, and it's an enhancement to our FMV valuation system. And you can run those vessels once you've put in just the IMO number, and it will bring up the vessel name, specs, year of build, country of build, and so on, as we can see on the screen. And you can then, once you're happy with those specifications, run the evaluation, and it will give you in Excel the output that you'll be familiar with from the FMV system. So we've got quarterly average TC rates and values, and we've got our long-term time series data on benchmark prices and vessel-specific or asset-specific prices, as well as the summary positions as well. So it's a really useful addition to the FMV system to make people's lives easier in terms of tracking portfolios, running valuations, and having that output directly in Excel format. So when we take a look at our outlook for earnings, we summarize that in terms of indices here. So we've got indexed crude tanker 1-year time charter rates and spot TCE, and equivalent for the product sector as well. So the dotted lines are showing you the spot indices, the solid lines, the 1-year time charter rates, and we've indexed these off 2016. So you can see the volatility, you can see that correlation I was talking about across these markets. And we can see the relative, now we've added in spot forecast to our market data, the horizon system. You can see also we've got the forecast for spot as well. You see that volatility of the spot movements around the 1-year time charter rates too. So the outlook really does reflect that fundamentals position that we saw a couple of slides ago. We've got, on an annual basis, the bottom of the market, really, the nadir in earnings in 2021 still. I mean, that's been the case for some time. We haven't made huge changes to our forecasts for the tanker sector in terms of their overall profile for some time. We've been tracking the market accurately, and we can see we've got that longer term recovery, as also indicated by the utilization rate going forward. The spot sector, you can see, is outpacing the time charter market, albeit from lower relative position in 2021, and we'll see that kind of increased amplitude in those time series. If you take the opportunity to look at those on horizon, you can see the differing position between the spot and the time charter market. But overall, it's a positive view post 2021, but it is still beset, as I'm sure everyone is aware, with significant risk.
Thank you very much, Tim and Kishan. Very informative, and yeah, you packed a lot of content in there. Okay, now it's time for questions. And the first question we've had in is, how do you feel the upcoming regulations, so by that we mean the sort of Energy 2 directive, will impact demand?
Thanks, Simon. Yeah, so obviously there's a lot of interest in the longer term demand picture and the energy transition. So really we've got two kind of facets to demand at the moment. One is the recovery and the immediate aftermath of COVID-19, and then we've got the longer term outlook, where clearly we're going to see, as I mentioned, an energy transition, movement away from fossil fuels, driven both by regulations and by technology, obviously vehicle electrification being a major component of that. So our base case view, and you can, if you have access to the Horizon system, you can see our longer term outlook to 2035 on there. Our base case is actually a slowdown in oil demand, a deceleration. We even saw some of that in the 5-year view we've presented in this webinar, but longer term things start to flatten out and then actually start to move lower. We're looking at the turning point perhaps towards the end of this decade or a bit further out. So that's part of our base case view. It's actually been part of our view for the kind of OECD for some time. So US and Europe, we expect to start to see oil demand trending downwards. Kind of demographic issues in regions such as Asia and so on mean that we're still expecting some longer term growth. So that provides quite a subdued outlook overall for demand. But I think one of the things I'd just add to that is, and I mentioned, we didn't really have a lot of time to look through, say, refineries, and also perhaps the dynamics between production and consumption by region. So we're seeing a lot of refinery closures in response to the reduced demand from COVID. We're seeing refineries grow in Middle East and Asia, but also there's been significant closures in Asia as well. So some of these are going to lend themselves to driving trade flows, even as underlying oil demand slows down. So particularly in Europe, we saw continued growth in product imports, but perhaps in places such as Africa, where we're seeing that Dangote project come in, some of that refinery shift is going to be negative for trade. But the overall driver of underlying oil demand will continue to be Asia, and that's going to take in crude from Middle East and Western regions as well. So that should be supportive for trade demand, even as we see underlying oil demand grow. But there's no doubt we're expecting significant deceleration in long-term demand.
Thanks, Tim. Another question makes a comparison between MSI and other associations like the IEA and the EIA and OPEC, and makes the comparison that MSI is quite conservative when you compare our forecast to that of to their forecast in terms of how they see global oil demand growing and reaching 99 million barrels per day again. Are we at MSI underestimating the demand recovery?
Well, I think the first point to note, and thanks, hi Lars, thanks for that question, is that we, as we saw in the slide, the summary of demand, we're actually still very positive on 2021 all demand growth. We're at 5 point something percent, kind of 5.5 or close to %. And I know the IEA came out with their oil market report this week, pushing up demand growth. To get to our overall annual growth of 5%, we still need very strong demand growth in the second half of 2021. And this kind of goes back to the point I made in terms of there's a bit of a dichotomy between what we expect to be very strong near-term demand growth for oil and the longer-term slowdown in growth. But we are seeing positive signs, and I think the slide I put in on aviation activity is kind of indicating that. And what I'd say is the second thing is in our quarterly reports, if you look at our Q1 quarterly report, we did a scenario. I mean, this was published some time ago now, but this scenario was directly anticipating stronger than estimated demand in 2021, 2022. So actually, we ran a tanker market scenario where we had global oil demand growing at 6% this year and another 6% in 2022. And because we're able to simulate these conditions on the Horizon system, and users can as well, you don't actually have to use our base case if conditions change or you want to look at a more optimistic or pessimistic outlook. You can run those scenarios. But under that scenario of stronger demand growth, we did see significant improvement and acceleration in the market across the forecast, and you can take a look at that in our quarterly report. So we are aware of the risks both on the upside and the downside to our forecast, and we do try and anticipate those or at least reflect those in our publications, in our scenarios that we run, but it's also something that you can have a look at yourself on the system. So
Thanks,
I think that's both the questions we've had in. Thank you very much for those.
That's all unfortunately we've got time for. Please remember that the recording and the document, the slide deck that Tim and Kishan have used today is available from MSI Horizon. It'll be available there shortly to download. And so thank you so much again for joining us, for taking the time out of your schedules to be with us today. Please do look out for future MSI webinars. Yeah, so thank you. Yeah, thank you very much and have a great day. Bye-bye.